All right, let's jump straight into today's explainer. We are looking into the systemic financial traps hiding right under our noses in modern homeowners insurance policies. Look, if you own a home, you probably feel like you've got your bases covered, right? You pay your premiums, you file the paperwork, and you figure your equity is totally safe if disaster strikes. But according to our source material, a quiet crisis is actively unfolding. The whole landscape is fundamentally changing. Protections are being systematically stripped away, and massive financial burdens are being quietly shifted right back onto families. So our primary focus today is twofold. We want you to be fully aware of exactly how these systemic changes are happening, and we're going to map out the critical steps you need to take to safeguard your protection against a massive financial setback. To really grasp the sheer scale of this, we just have to look at how states are reacting. Take Georgia, for example. They recently passed legislation letting homeowners set up tax-free catastrophe savings accounts. You can stash up to $250,000 in these accounts specifically for your insurance deductibles, and it even passes tax-free to a spouse. Sounds like a great perk, right? Well, as our source points out, imagine if a doctor slapped a Band-Aid on your forehead to cure a migraine. This legislation is basically a giant flashing warning sign. It doesn't actually fix the root problem of diminished policy protection. Lawmakers are incentivizing you to save up because they know you're likely about to get hammered by out-of-pocket costs. It's treating the symptom, not the disease.
And that brings us to the actual threat lurking inside the fine print. It all comes down to two acronyms, RCV and ACV. You really need to know the difference here. RCV is replacement cost value. This is the good stuff. It's what most of us reasonably expect. It pays the full current cost to replace your damaged property, like a busted roof. But increasingly, policies are quietly utilizing ACV, or actual cash value. This sneaky little method factors in the age and condition of your roof, heavily depreciating its value, which means they pay out significantly less. The inherent danger here is that companies are actively shifting the financial burden onto you by covertly swapping the robust RCV coverage you expect for the ACV coverage that leaves you completely stranded.
So, how are they actually pulling the switch off? Well, they do it using something called a storm trigger. It's a hidden provision buried deep in your policy, and it's activated by very specific things, like a wind or hail event. You might buy an RCV policy, think you're perfectly protected, and lock it away in a drawer. But the second that storm hits, literally the exact moment you need the coverage the most, this trigger activates. It covertly converts your rock-solid RCV policy into a weakened ACV policy. Basically, your coverage looks fantastic on paper, right up until the wind starts blowing. Let's actually run the numbers here, because seeing the math really makes it click. Imagine the standard expectation, the straightforward RCV scenario. Say a storm completely wrecks the roof on your detached home. It's going to cost $20,000 to replace it. If you have a straight RCV policy with a flat $1,000 deductible, the math is beautiful. The insurance pays $19,000 and you cover your totally reasonable $1,000 out of pocket. Boom, done. This is the safety net working exactly as it was designed to work. But here is the devastating reality check when that storm trigger activates the ACV scenario. Let's look at that exact same $20,000 roof. Only now the adjuster slaps a 50% depreciation on it because it's a few years old. Bam! That immediately knocks $10,000 off the payout. But wait, it gets worse. Instead of a flat deductible, your policy had a hitting 1% percentage deductible based on the face value of your $200,000 home. That's another $2,000 gone. Suddenly, the insurance is only kicking in $8,000, and you are left scraping together $12,000 for the repair. You are paying more than the insurance company. Brace yourself, because it can actually get worse than that. Think about what happens if the fine print hides a 5% percentage deductible instead. If you apply a 5% deductible on a $200,000 home, well, that's $10,000 right out of the gate. If your heavily depreciated roof payout was only calculated at $10,000 to begin with, the math nets out to exactly $0. That's right, zero. No way around it. You could have a fully approved claim with every single piece of paperwork filed and accepted by the adjuster, and they will legally write you a check for nothing. You're left holding the bag for the entire replacement. And even if they don't switch you to an ACV policy, those storm triggers can still attack you from a totally different angle. Instead of changing the valuation method, the trigger just hikes your deductible. According to the source material, a hail or windstorm can trigger a clause that changes your flat $1,000 deductible to a $5,000 deductible the absolute second a storm gets an official name. That is a staggering 500% increase literally overnight. So going back to our $20,000 roof scenario, the insurance pays $15,000 and you suddenly owe $5,000 completely out of nowhere.
Okay, let's take a collective breath and pivot to some surprisingly good news. Ask yourself this: what actually covers a lawsuit if a freak accident happens while you're away on vacation? You're probably thinking, what does that have to do with my house? But this highlights an incredibly powerful, yet vastly underutilized section of your policy that you absolutely need to know about.
We're talking about your personal liability coverage, which you can usually find under Section 1 of your declaration page. This hidden gem is basically a financial force field for your entire household. You, your spouse, your older kids, protecting everyone from financial ruin due to lawsuits. If someone gets unintentionally injured and decides to sue you, this steps in. It covers the attorney fees, those brutal court costs, and even the final judgment up to your policy limit. And the really amazing part, it covers you even if the accident happened hundreds of miles from your house. Out of state, down the street, or lounging on vacation, you're covered. And the law actually already requires a minimum of $100,000 in coverage with zero deductible. But here is the absolute kicker, and it's a massive piece of leverage for you. The source material strongly recommends bumping this liability protection to at least $300,000. But astonishingly, taking that protection from $300,000 all the way to $500,000 can cost as little as $10 a year. Let that sink in. That is literally less than $1 a month to wrap your family's hard-earned assets in hundreds of thousands of dollars of extra protection. It's got to be one of the most cost-effective defensive plays you can possibly make.
All right, so what's the game plan? Here is the definitive action plan from the source to prevent getting clobbered by your own policy. First, grab a magnifying glass and check your declaration page today. Look right now to see if you're on RCV or ACV. Second, comb through that fine print, specifically hunting for those storm triggers and percentage deductibles. Third, if you find these toxic provisions, do not, I repeat, do not wait until your renewal date. Change a bad policy immediately before a storm rolls in and wipes out your retirement fund. And finally, if you do have damage, remember the adjuster works for the company, not you. Keep it brief, stay silent, don't make small talk or volunteer extra info, because they are often on what the source calls a fishing expedition to find any excuse to minimize your claim.
Now, when you take that advice and go shopping for a better policy, you really need to know who is sitting across the desk from you. There's a huge difference between captive agents and insurance brokers. Captive agents are employees tied to one single insurance company. And sure, they might offer incredible customer service, but do not mistake a friendly chat for true representation. At the end of the day, their loyalty is to their employer. If you want someone proactively in your corner, you need an insurance broker. Brokers are independent. They can shop around across multiple carriers to find you a smart, clean policy without any of those underhanded surprises or hidden storm triggers.
The landscape of home insurance really has shifted beneath our feet, and the financial burden is quietly being transferred straight to the uninformed homeowner. So as we wrap up this explainer, I want to leave you with one critical question. Will you check your policy before the next storm hits, or will you just pay the price? You've got the knowledge now. You can spot the ACV traps, find a solid broker, and lock down your personal liability. Take the steps today to safeguard your protection and make absolutely certain that when disaster inevitably strikes, you're the one holding the safety net, not the massive financial burden.